Welcome to Trading Nation. I'm Brian Sullivan. Pleased to be joined once again by David Tice, who's known for running the Prudent Bear Fund, which he sold to Federated back in 2008. Hard to believe it's been almost a decade ago. David, good to see you on Trading Nation again.
Nice to be here, Brian.
You know, you've got a really interesting thesis. You're known as being a bear, but, and I don't want to misquote you, so tell me if I'm wrong. From what I read, you believe there's a 50% chance we could go up another 25% in equities, but there's a 25 or so percent chance we could fall 40%?
Yeah, actually, you know, I was thinking of those numbers. It's actually 25-50. So 25% chance that we could have a 50% decline, but there's potentially a 50% chance that there will be a 25% rally.
How can we have both, David? How can both those things be possible?
Because it's probabilities. Therefore, we could have a black swan event that you can't ever predict. And, you know, I think there is a great chance of a black swan. I mean, I think that it's possible with Trump in office, we could have moved towards impeachment down the road if it looks like the House is going to go Democrat. There could be a North Korea situation. There could be a gold physical versus paper, you know, blow up. There's all kinds of things that could happen. It could be a event in the credit markets, et cetera. But then the weight of the evidence is, if you put a gun to my head, I think the market's going up some more.
Which for you, I mean, a guy that's known for being bearish, is that hard to say?
So last time I was on your show, I said the same thing. I don't know if it was 3 or 4 months ago, and, you know, we were right. And I think it is kind of hard for me to say. But then when I look at 00, you look at 08, and you look at 87 even, there was a ton of speculation. And yes, there's speculation, but you know, the individual investor is starting to come back in the market. Schwab just showed some bigger numbers, but you know, people still aren't talking at cocktail parties about the hot stocks.
No, they're talking about Bitcoin, David. They're talking about Bitcoin.
Exactly. That's exactly what they're talking about. And a lot of times in 99 and in 86, you ended up having, you know, 80% rallies before the decline. And therefore, you know, I've been wrong a lot by being too early. And I know where this ends longer term. Longer term, I'm completely confident this market is going to be down a lot. And if you look at 147 years of Case-Shiller, cyclically adjusted PEs, this market is only 4 times in 147 years has it been as high as having a plus 30 times cyclically adjusted PE. And when you have that kind of level, the next 10 years return is going to be anemic. And therefore, longer term, market's going to suck. But, you know, shorter term, it could go up some more.
Okay, so let's say you have a guy, a couple young kids, mid-40s. I'm just asking for a friend here, David, who's investing for the long term, because that's what we're told. You invest for the long term, and you should always remain invested. You believe that, but let's say I listen to what you're saying, and I believe you. I'm worried about the markets as well. Not me, but the viewer is worried about the markets. What can they do? What should they do? Buy a bunch of gold, buy some puts, buy some Bitcoin, hedge their bets, sell some stocks, buy bonds, what?
All right, so here's what I would advise. One, the thing I believe the strongest in is gold. Gold is going to be up 5-fold over the next 10 years. I would bet on that big time.
But a lousy decade for gold, David. You know that.
I know. Well, the last, we've had 4 years out of the last 6 that gold price has been down. It's rallied off the bottom. It's up the last couple of years. You go back to the 00 and gold has outperformed the S&P. You actually go back to 71, gold has outperformed the S&P. So gold is a longer term place to be, and this kind of fiat money, gold's going to be a place to be. So you need to be protected there. Frankly, I'd go 15%. In terms of Bitcoin, I think you need to own a little bit of Bitcoin. I think there's probably going to be a 40% cut pullback. You know, I think there's going to be a number of 40% pullbacks. But I think Bitcoin is going to do something. And in this fiat currency world that we have, where you're going to have currencies fall apart, Venezuela, Argentina, et cetera. You're going to want to, Bitcoin still is a relatively small market cap relative to the whole financial market.
Here's the the difficult question, David. Can you be a believer in both gold and Bitcoin? A lot of people say, sell gold and buy Bitcoin. Can you like both?
You can like both because in my view, there are three big currency competitors. There's the dollar, there's Bitcoin, and there's gold. And gold and Bitcoin are both anti-fiat money. And I think people are sniffing out this fiat money environment that's dependent upon confidence in central bankers. And central bankers debase currencies. That's what they do. And that's one of the attractions of Bitcoin is you know what the supply is going to be. Same way with gold. Gold only goes up 1% a year in new supply. People have looked at thousands of years of monetary history. They know gold is going to buy, a good man's suit. You're going to protect yourself with gold. So you can own both. In fact, I think you should own both.
All right, so I cut you off because I wanted to ask about gold. So 15% gold, a little bit of Bitcoin. What would you do with the remainder of a portfolio over the next 10 years, 15 years, if what you believe a pullback in equities is going to happen?
So if you are a true longer-term investor and you're not watching the market, every quarter and you're not trying to squeeze out every nickel, then I would not be in stocks because I'd look at that Case-Shiller indicator that says when stocks are in the fifth decile as far as valuation, the 10-year performance is likely to be 4% a year. That's pretty anemic. So if you are truly longer term, then maybe you have 20% in stocks, but I wouldn't have more than 50% in stocks. If you think you can be really smart, you think you can get out, you think you can play it for, 6-8 months, then I can't argue about you being in stocks and playing it. But it's still a greater fool theory bet. It's a bit of Ponzi investing type of bet. And I think it's dangerous. So if most individuals, I don't think should be in that, but I think that you ought to be a little bit more careful. If you truly want to play it, realize the risk you're taking. And, even though if you are invested at the very peak in like 1929 or 1966, it can take more than 20 years to recoup your original investment on an inflation-adjusted basis historically in those couple of example years.
The always contrarian David Tice. David, really interesting view. As always, a fascinating conversation. Appreciate your time. Hope to get you back on Trading Nation in the new year, all right?
All right. Glad to be with you.
David Tice.
You're doing a great job on the show.
Oh, thank you very much, David. I appreciate it. And folks, thank you all for tuning in to Trading Nation. I'm Brian Sullivan. We'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.